6:45. Same building. Same brand on the door. Derek waited in line for 23 minutes to make a deposit. James was served coffee while his banker handled the same deposit in the background as a courtesy. Each of them needs to borrow money this month. Derek's transmission failed. He needs $4,500 to fix the car he uses to get to work. He fills out a paper application at the branch, waits 4 days for a response, and is denied. Not because the amount is large, but because his credit score is short, his account history shows the recent overdrafts, and the bank's risk model classifies him as high default probability. He's offered a secured card instead, where he would deposit $500 of his own money to get a $500 credit line. He's lending the bank his own money so the bank can lend it back to him at 24% interest. Tyler needs $20,000 for a kitchen renovation. He applies online from his couch on a Sunday night. By Tuesday morning, he's approved at 6.9%. The decision is automated, the paperwork is electronic, the funds are in his account by Wednesday. The process is fast, functional, and exactly the way most people imagine banking is supposed to work. James needs $2 million to bridge a real estate purchase before his existing property sells. He doesn't fill out an application. His banker calls him, asks what rate works, and proposes terms that are negotiated in a single conversation. The rate isn't on any website. It isn't published anywhere. It's lower than what Tyler was offered for a $20,000 loan on a balance 100 times larger. Professor Wealth here. The price of money is lower for people who already have money. That isn't a metaphor. That is the literal mechanism. Derek was offered 24% on $500. Tyler was offered 6.9% on $20,000. James was offered roughly 4.5% on $2 million. Across the lifetime of those loans, the difference in interest paid per dollar borrowed is staggering. The customer least able to pay is charged the most. The customer most able to pay is charged the least. This is how wealth compounds through the banking system before any investment ever happens. Something goes wrong, eventually, for all three of them. Derek notices a duplicate charge on his account. He calls the customer service number on the back of his card. The hold time is 34 minutes. The voice he eventually reaches is friendly, but reading from a script located in an offshore call center and authorized to handle standard issues only. The duplicate charge dispute requires escalation. The escalation requires a callback in 3 to 5 business days. Derek hangs up, not knowing whether his money will come back. Tyler calls about a fraud alert that froze his card while he was traveling. The hold time is 6 minutes. The agent is domestic, speaks to him directly, and unfreezes the card in the same call. The problem is solved before he finishes his lunch. James doesn't call customer service. He doesn't even know what the customer service number is. When something needs attention, he texts his private banker, who responds within 10 minutes, often within 1. There is no script. There is no escalation. The person on the other end has the authority to fix the problem in the moment because the entire structure of the relationship is built around making sure James never experiences friction. Derek calls back to ask if the bank can waive the $35 overdraft fee. He explains the paycheck timing. He explains it was a small charge. The agent is sympathetic but reads from a screen that says, "No, the policy is the policy." He pays the fee. Tyler asks his banker about a wire transfer fee that hit his account. The banker checks his profile, sees his average balance, and waives it as a one-time courtesy. Tyler thanks her and goes on with his day, vaguely aware that the system bent slightly in his favor without him having to push hard. James never asks. The fees that technically apply to his accounts are waived automatically before they appear, by people whose entire job is to anticipate friction and remove it. Exceptions that would require manager approval at Derek's tier are approved before any manager is consulted at James's tier. Same policies on paper, different discretion in practice. Professor Wealth here. Banks don't break laws for wealthy clients. What they do is exercise every legal degree of discretion available under their policies in favor of the clients whose relationships are worth preserving. That discretion is the entire ballgame. It's also why the system feels so different at different levels. The rules don't change, the willingness to bend them does. All three of them are looking at homes this year. Derek is hoping to buy something around $250,000 with an FHA loan, the smallest down payment he can manage. After his recent overdraft history, his application is conditional. His rate is offered at 7.8%, and he's required to carry private mortgage insurance because his down payment is under 20%. Over 30 years on a $240,000 mortgage, the total interest he'll pay is roughly $381,000. He'll pay nearly two-thirds of $1 million to borrow $250,000. Tyler is buying a $500,000 home. He puts 20% down. His rate, based on his stable income and credit profile, comes in at 6.3%. Over 30 years on a $400,000 mortgage, his total interest is about $490,000. Higher home price, lower rate, lower total cost per dollar borrowed. James is buying a $4 million property. The rate his bank offers him isn't on the website. After negotiation, he closes at 4.6%. Over 30 years on a $3 million mortgage, his total interest is about $2.5 million. That sounds enormous. It is enormous. But per dollar borrowed, James pays less than half the interest Derek does. Derek pays roughly $1.59 in interest for every dollar he borrows. James pays roughly 83 cents. Professor Wealth here, the math is the math. The customer who can least afford it is paying the most. The customer who can most afford it is paying the least. And this isn't a glitch in the system. This is the system. The bank isn't being malicious, it's pricing risk. But the result is a structural transfer of wealth from people who borrow expensive money to institutions that lend cheap money to people who don't really need to borrow it in the first place. Here's what each of them knows about their bank and what their bank knows about them. Derek's bank doesn't know his name. He's an account number in a database. The system knows his balance, his transaction history, and his risk score. It does not know that his sister has been sick, that his car repair was unavoidable, or that he's trying to do everything right. The bank's interest in Derek is purely automated. He is, in their internal language, a cost to be managed. Tyler's bank knows his name when he walks in sometimes. He gets generic emails about products he might qualify for. If he called and threatened to leave, someone would probably try to retain him with a small offer. He's a customer in the way a customer is a customer to any business. Valued while present, replaced without ceremony if he leaves. James's banker knows his children's names. She knows about the foundation. She knows what he's trying to build and what he's trying to protect. His relationship with the bank is a named line item in someone's performance review. Losing him would matter to her career, to her team's metrics, to the regional manager above her. He is not a customer at this level. He is a relationship. And that single word, relationship, is the entire difference between being served by an institution and being processed by one. So which one are you right now? If you're Derek, the system is charging you for being where you are, and the path out is uncomfortable but real. It starts with stabilizing cash flow, killing high-interest debt, and getting your balance above the threshold where the bank stops penalizing you for existing. If you're Tyler, the system is treating you fairly, but you're not large enough yet for it to compete for your business. The leverage starts somewhere around the $250,000 mark and accelerates from there. If you're James, well, you already know how this works. You're not watching this video to learn anything. You're watching to confirm that what you experience daily is what most people don't see. Here's what nobody at any tier tells you. The bank isn't your friend, the bank isn't your enemy. The bank is a business that prices you according to how much value you generate for it. Understanding that, really understanding it, is the first step to using the system instead of being used by it. I'm Professor Wealth. If this video helped you see something you hadn't seen before, the best thing you can do is share it with someone who needs to see it too. And if you want to know exactly what it takes to move from one tier to the next, that's the next video in this series.